Episode 25, Capital Structure. Who's paying for Flip's coconut empire? Starting with capital structure. Capital structure is how a company pays for its dreams. You can either borrow money from crab bankers, which is debt, or sell part of your coconut empire to crab investors, which is equity. In simple terms, it is basically asking who is funding the party and who is going to complain about the music. Why capital structure matters. The way you fund your business affects how much control you keep, how risky your finances are, how attractive your company looks to investors, and how loud the crab banker knocks when you miss a payment. Turning to debt. Borrowing coconuts. Debt means you borrow money and promise to pay it back with interest. It is like renting coconuts from crab bankers. They do not want equity. They simply want their coconuts back, with extra coconuts added on top. The pros of debt are that you keep full ownership, interest payments are tax deductible, which means the government lets you subtract them from your profits before calculating how much tax you owe, and crabs do not get voting rights. The cons are that you owe money no matter what, and too much debt can lead to crab-induced panic. You can learn more about debt in episode 26, or don't. Shifting to equity. Sharing the coconut pie. Equity means selling part of your company to investors. They give you money, and you give them coconuts, along with possibly a hammock and voting rights. The pros of equity are that there is no repayment pressure, you gain more flexibility, and investors share the risk. The cons are that you give up control, profits get shared, and investors might even want to rename your coconut stand to Crab & Co. Episode 27 will go deeper into the nuts and bolts of equity. Finding balance, the coconut ratio. Too much debt and you are juggling coconuts on a tightrope. Too much equity and you are hosting a crab party with no coconuts left for yourself. The goal is balance. Enough funding to grow without giving away the beach. Considering the cost of capital. Every funding source has a price. Debt comes with interest. Equity comes with investor expectations. The blend of these costs is called WACC, which stands for Weighted Average Cost of Capital. It is like your company's financial heartbeat. If it is too high, you are financially wheezing. Understanding the pecking order, companies usually prefer funding in this order. First, internal funds from profits. Second, debt, which is borrowed coconuts. And third, equity, which means selling coconuts. Why this order? Because giving up control is a big deal. It is like inviting crabs into your beach hut. They will want a hammock, a vote, and a coconut smoothie. Examining leverage and risk. Leverage means using debt to boost returns. It is like climbing a coconut ladder to reach higher profits. But if the ladder is wobbly, you might fall and you might land on a crab. Looking at restructuring, rearranging the coconut crates. Capital structure can change over time. Companies can issue new shares, buy back stock, refinance debt, or merge with another coconut empire. It is like rearranging your coconut crates to survive storms and impress investors. Let's look at a real-life example. Flip's Coconut Cafe. Yes, I'll be talking about myself in third person. Flip wants to open a coconut cafe. Option A is to borrow £100,000 from crab bankers, which would make the structure debt-heavy. Option B is to raise £100,000 by selling shares to crab investors, which would make the structure equity-heavy. Option C is to use a mix of both, which creates a balanced structure. Flip chooses option C. He keeps control, gets funding, and avoids crab drama. Smart Flip. Here is my final thought. Capital structure is like choosing your coconut crew. Pick wisely, because once the crabs are in, they are hard to get out, and they always want a slice. Subscribe, or don't. I will be here, explaining why your coconut empire needs a solid financial foundation. I will be in flip-flops and probably negotiating with crab bankers.